Hi guys, and welcome to the Fife Property Show. A really interesting topic we've got today is tax for landlords, allowances to claim, efficient expenditure and easier accounting. Now, today I've got to discuss subjects with me today. I have Jim. Now, Jim Parker. Jim, you
I am completely in my element today.
I was just going to say.
It's like, I'm an accountant by trade. This floats my boat completely, and I'm an investor. Way.
Yeah, Jim. I mean, I think being an accountant by trade, obviously, this is right up your alley, and also being an investor and a landlord yourself. Of course, you learn these things firsthand. Also, we've got James Watson joining us today. Morning, James.
Hi, Richard.
Hiya.
How you doing?
This will be an interesting topic for you as well, James. Obviously, being a landlord investor yourself.
What's it like for you now, James? Just out of curiosity, how long have you been doing this, and how do you feel about the accountancy aspect?
So, accountancy for me isn't a big issue. I'm a previous business owner. I did have an IT contracting business, so I'm well aware of keeping all the receipts and all that good stuff. Property is just more or less the same sort of idea.
Yeah, it's knowing what to claim and when to claim it, though. I mean, most expenses will be similar, won't they? But there is slight variations in the tax rules for investment income, because we're classed as investment income. You could have 1,000 properties, right, and buy to let, and you're still classed as investment income. Work that one out.
Absolutely.
Yeah, I think those are all good points, obviously, that we're going to cover today. And I think with the annual tax return deadline, obviously, looming, and it's only a couple of months off, then it's the best time to explore preparing in advance to avoid the late night uploading on the January the 31st, which I'm sure maybe not Jim, because I know you're super organised, but James, You've maybe experienced that in your time. And it's not a good position to be in. You need to be prepared and think ahead before, obviously, that date. A lot of tips we're going to cover today can make things easier for you to start right now and then use your Christmas break to then collate all your receipts, like you say, James, claim your allowances and submit your return well before the deadline.
Does it no sound about like Ebenezer Scrooge? Use your Christmas break.
Break?
just the way we've said that, use your Christmas. You could just sit there with your till receipts going, there's that, and with your calculator. And it's like somebody comes in and goes, would you like some turkey? No, go away, humbug.
Yeah, I think the key is obviously to break up tasks, and obviously most of us leave things to the very last minute, which means a slow build up of anxiety, and this grows obviously until the deadline obviously looms. Unfortunately, it doesn't have to be that way, and there are some tools at your disposal to make you make tasks feel smaller and manageable, and we're going to cover a couple of them today. I think as we talk about receipts and things, maybe paperwork systems, people find a wee bit overwhelming. And a neat trick to do, if paperwork is something that you're confident dealing with, is to have maybe 12 separate envelopes and have them all marked, obviously, for each month of the year. And then what you do is drop your receipts in there each month, and if they're not clearly marked, there you go, James. If they're not clearly marked for what they are, then write it on the envelope. And at the end of the year, you've got these 12 envelopes, and that's quite a good system to work with if paperwork's your thing. I mean, like I say, sometimes paperwork could overwhelm people. I was just about to say to any use practice, but James has just obviously demonstrated that. Let's see then, Jim.
This is it.
That's better organised than my lawyer's office.
I tell you what though, I'm quite good with it, because the key is I actually make sure it's updated on a regular basis every week in the system, in my accounts. So while that looks like a mountain of paperwork, the reality is it is just record keeping for what's in the system. Yeah,
I was going to say, Jim, because you'll have it all, obviously, it is all systematized. I know that because obviously you manage your properties and you also have an account as well.
But it means that how many landlords at this point in time will be going, oh, I could relate to that. And it's like, but they've not actually got a system. They're just waiting on collating that at the last minute.
Yeah, but I mean, obviously, there is a good way, obviously, divvying it up and being a wee bit more organised with your paperwork.
I would agree.
There's also a lot of, like, the online banking apps and things are quite good nowadays, and I assume you probably do online banking. I do myself. And there's a lot of that could obviously, they could split up your accounts and things, and this means you could tag your buy-to-let expenditure to find it easy when the tax time comes. And there's even apps for expenses where you can photograph receipts and obviously download them in, and then the payments and turn your paper trail into a digital one, which is quite nice.
I use Tide, and Tide's got its own sort of invoicing element to it.
Yeah.
So all my receipts can get scanned in or photoed, and immediately updates balances and things like that. So there's a reconciliation gets done.
Yeah, and I've stuck to Sage over the years. So I started off with Sage Instant Accounts many years ago, and then I've moved up to multi-company structure because I've got several companies now and several properties. So I've moved up to that, but I tend to make sure that I follow the banking system. So I make sure most of my stuff goes recorded through the banking system. Therefore, I've always got a historical audit trail of what happens. And then it is literally just making sure that's reflected in Sage in the right accounts. And what I mean by accounts is if it's repairs and improvements, if it's gas, if it's utilities, if it's council tax, if it's water, if it's anything else. To make sure it actually falls into that right category, so when it gets to the year end, you can just hit a button and it produces it.
Yeah, absolutely. The paper
that's the great beauty of online apps.
Yeah, and the paper record keeping is absolutely essential, because if you've got a knock at the door from HMRC wanting to do an investigation, then you have to have that, and they maintain that you should have 6 years worth of records.
Yeah, and then if they find something wrong, and it's back at the 4th year, they can actually go back 6 years from that year. And then if they find back from the 5th year from there, they can go back 6 years from that point. So they could go right back to almost the very beginning when time began for you, and basically haul you over the coals. So it's probably one of the most important things you can do, but taking the right advice from the right people is key, and we're going to talk about that.
Yeah, I think it is a really important element, and you have to do it right. And like James says, if you're going to get audited, then you better make sure you've got all your paperwork in order, and not just for the previous year, like you say, for the previous 6. And if they pick it up, then further than that. Speaking of apps and things, there's a lot of popular apps out there. Jim, you said Sage, obviously. Sorry, what did you say, James?
My bank account is Tide.
Yeah, there's a lot of ones. There's like things like QuickBooks and all the rest out there.
And there's also, I think there's Zero as well. I think that's another one.
Yeah,
Free Agent is another one.
Yeah, so these are all good tools to use, and I think ideally, if you're got the ability to use apps and things, and only just like obviously receipts and paperwork, it's a good way to keep a track of things.
I'd be interested to hear if anybody else out there what they use apart from the ones that we've just mentioned.
Yeah, because there is a lot
that we've just mentioned. Because it'd be interesting to hear from them if that is the case, or if there's any other apps out there that they think was better for them or is better for them and using for their buy-to-let business and their investment portfolio.
Yeah, definitely. Stick that in the comments and share it with us, and obviously anybody else that's watching. We'd be interested to know. Like you say, Jim, obviously you have got quite a big portfolio, and tax could get obviously a wee bit more complicated and things. So you use an accountant.
Yeah, I've predominantly got a bookkeeper. It does well. I do bits now and again because I do have overall access to the system. But so I'll do maybe tidying up now and again when I want. But predominantly, I've got a bookkeeper that works on the day-to-day basis, on a part-time basis. And then, I've learned from my experiences that you pass it to an accountant at the year end once you've done all the donkey work in the beginning, and they just finalise everything and submit the accounts. It does make good sense. I mean, you can do it yourself, and I did it myself in the early days. But using a proper accountant and a clever accountant, I'm not just saying any odd accountant, is probably the best way to go if they understand property tax. That's the key here.
Yeah,
you've got to get an accountant that understands property tax. Otherwise, you'll just I'll just submit it by what you've given me and make any changes to stuff, but I'll not give you an advice because I don't really specialise in that area.
Yeah, it is important to have, if you've got somebody dealing with your stuff, then they need to know the ins and outs of property tax properly.
Can I give you a good top tip? Here's a good top tip, and using a managing agent is a really good option.
Yeah,
and
that's I was just going to.
Yeah, for most small landlords, okay, or investors that are just starting out, if you've got a managing agent, they'll do all the work for you if everything goes through them. Because, you know, in theory, you should get one remittance every month, and it should have your income, and it should have any outgoings, including repairs and improvements, if you've authorised them to do it. So literally, if you had one property and they ran that property and you did nothing else, you could be literally taking 12 remittances and just passing on to your accountant and go, that's my property for the year.
Yeah, if you've got a managing agent who's doing that properly, like you say, Jim, in theory, it's that simple. And it saves you a lot of the work. We do it ourselves, obviously. Jim, obviously, we manage yours, and that's how you'll receive your remittances and things each month as well, and they will go onto your accountant and they'll put them together for your tax return. And that is really a simple way of doing it. Sorry, James.
That's exactly how I do it, but also send on a spreadsheet with a high-level overview of everything that's went in and out.
Yeah.
So they've got it at a glance rather than fumbling through remittances.
Yeah, that's right. I mean, that is the key. I mean, as long as you've got some sort of KPIs at the top, and then if you want to drill down, you know, you can drill down from there, but then you could go on to individual, you know, invoices, expenditure, or rents coming in, just to, you know, if you want to find out what's happened. I mean, classic example from year to year. This is probably why you do the accounts and you make sure you compare them year to year and you think, okay, does my top line income reflect exactly my same top line income as last year? If you've got the same amount of properties, if it doesn't and it's a lot more, then you go, okay, so how's that happened? Is my occupancy rate going up? Is my rents going up? Is it a combination of both? And that's why you would want that. Yeah, that's why you'd want that. And then if your overheads have gone up or come down, then you can do something similar and you can analyse that as well. What top tip for here for the tax man, and it might be there later on, and I might mention it again, is make sure from year to year the proportionate amount of deductions. In other words, if your expenses were 60% of your income, I'm just saying overall 60% of your income, make sure the next year that your expenses are probably around about that same figure, about 60% of your income. Because what happens is their whole system works on the principle that if your expenses are maybe 80% this year, it flags up in the system and spews it out. It's called an exception reporting. So that's how the tax man works. They don't look at every single tax return. They look at exception reporting. So they just look at the big swings from year to year about, you know, what did you have last year? What did you have this year? What is the industry standard compared to what you're doing in the percentages overall, not the numbers? And that then spews out a report, which then says we should maybe look at that a bit further. And that's how you get a visit. That's why I've never been visited in the last 25 years.
I was never visited either. But I've still got all the records.
Well, yeah, that's a brilliant tip.
Well, you're meant to keep them for 6 years, but I've got everything right back to the very beginning, almost 30 years ago.
I think I'll go back as far as 2006.
Yeah, I mean, that seems quite reasonable, and I think it's just good practice to have a record going back a certain amount of period just to kind of safeguard in the event, obviously, of audit and things as well. I think also we'll look at using your allowances, obviously, your advantage, and the best way to minimise your tax bill is obviously to take advantage of your tax deductible expenses as well. There are more allowances than landlords realise, I think, really, and I've spoken about this recently, and people aren't fully aware of what the tax deductible allowances are to them as a landlord, and they mount up to a significant saving in your tax bill, and having a good managing agent is really important again on your side, because they'll help you claim everything that you're entitled to without having to do a lot of research. Obviously, if we're doing repairs that are not deemed to be obviously improvements, if they are tax deductible repairs, then obviously we'll make you aware of that. And there's a lot of allowances that are available to a landlord, and I've got a big list of them here, and I'm just going to run through them quickly. Just obviously, okay.
You can fill in the blanks. Okay, James, what do you think? What do you think allowable allowances in the beginning? in terms of expenses and that, what would you tick off?
Right, so right at the beginning, I have 2 properties in my name before I even started the limited company.
Yep.
And I work in an industry that has above the national average salary. So I've got the potential that I could end up getting caught with a higher rate of tax.
Yep.
So one way to mitigate that was to increase my salary sacrifice contribution into my pension, which then lowers my take-home pay and then has a knock-on effect with the rents I'm able to get without hitting that high rate tax threshold.
Perfect. That's a great answer.
Yeah,
some of the other allowances you would normally have from day to day is probably, well, if you're using a letting agent, you could use a letting agent. There's a bit of ambiguity between improvements and, well, what's called as capital expenditure, which is an improvement, and a revenue expenditure, which is something that's instantly deductible. I think the taxman in most cases now would argue that, or we would argue, and the taxman would probably agree that in most cases now, you don't really get that many improvements anymore. Most of the things are actually just instantly deductible because most of the houses have actually got everything in them. It was there before. So an improvement, let me explain that. An improvement is something that wasn't there before that you've put in. For example, if you didn't have a bathroom or an ensuite and you added an ensuite onto your bedroom, that would be classed as an improvement. And it would be actually capitalized. It wouldn't be deductible against your rental income straight away. If you were to replace your ensuite, which was there already, it would be revenue and it would be instantly deductible straight away. So even if you replace an old Sky, shower and stuff like that, and put a brand new one in, top of the range if you want, it's entirely up to yourself. That would be instantly deductible against your profit. If you do have single glazing, it was brought in years ago that they would allow double, because everybody would replace with double glazing anyway, wouldn't they?
Yeah.
So they allowed double glazing to be a replacement now for single glazing, and that's the one that the taxman got caught on me with. And I told the story before, but I'll tell it again. I had done £30,000 worth of what I had deemed at the time was improvements in terms of putting double glazing and doors in. Now this was back about 25 years ago. So it was a lot of money at that time. And then I had actually put it down as improvements. Therefore, my tax bill was actually quite high. After he visited me, he actually came back and said, no, that was actually changed last year. It's now revenue expenditure because we expect. That's why I just said about they accept the fact that you would replace with double glazing rather than single. And he had to pay me back £1,000 in tax. Happy days. And instantly deductible. But then they get you on the upside, and the fact that if you do decide to sell, then they've nailed you with more capital gains tax. So you've kind of got to think about where that sits. And if you're never selling, it wouldn't make any difference then. If you're never selling, the most important thing is actually to get everything through as a revenue expenditure. So other things, costs for gardeners, window cleaners, house cleaners, council tax.
Council tax.
Just as I said before, if you've got no tenant, you've got a void, council tax.
Factor fees.
That's a good one. I've got that on a few of them, factor fees.
Yeah.
Clearly maintenance and repair costs, which we talk about, which will probably be the biggest amount of deductions that you'll have if you've got properties that are not new build. I mean, if you've got new build, you're probably that pretty minimal. But if you've not got new build, which probably you should have, I didn't think you should really be buying new build for buy to let because it's not really that efficient. There's a huge amount of profit built into there from the builders. You should really just be buying, refurbing, and actually capitalising on that way, and that will be deductible. So it will genuinely be things like a replacement kitchen, a replacement bathroom, replacement windows, replacement heating system, carpets, decoration. Anything else, James?
I think you've hit more or less all the main ones, to be fair.
Aye.
Insurance.
Well, insurance, that's another good one, yep. Buildings content insurance, accountancy fees.
Yep.
What else? Dare I say it, it'll come to it on some occasions as eviction costs.
Yeah, legal fees if you need to do evictions.
In terms of that, you can keep the eviction cost to a minimum if you do the process in the right way, because you generally find that the tenants that actually let's talk about eviction. We only evict tenants, and James will probably agree with this. You only evict a tenant in the last resort. It's like the last thing you want to do in the world is evict a tenant. And the only reason a tenant is getting evicted is because they're refusing to pay the rent when they can, or they're antisocial behaviour and they're actually disturbing everybody and they're damaging the property. That's about the only two things you'll ever want to evict somebody for. Apart from that, it's like there'll be no other grounds unless you want to sell it or you want to move back in it. But that's really it in a nutshell. So eviction's always the last resort.
Yeah. In terms of expenses, I've thought another two. So you can claim mileage if you're having to go out and site visits and whatever else.
Good shout.
And also...
now, how much allowance do you do? Do you do 45 pence per mile?
So you get 45 pence a mile up to 10,000 miles and then 25 pence a mile thereafter. But then obviously if you're doing ridiculous mileage, then that might get questioned.
Yeah.
Always keep your investments kind of close for that specific reason.
Yeah.
What was the other one I was thinking of? Working from home allowance. I think you get £6 a week for working from home that you can claim.
Yeah. That's a good shout. I mean, it all adds up, doesn't it?
Well, it certainly
also
does.
Phone calls and things as well if you're self-managing that as well.
Phone calls, a proportion of your mobile phone. If you're using your mobile phone, you can actually claim maybe a proportion. So if you use your mobile phone, typically they try and get away with saying you only use it 10%. But if you can prove it, you're using it about 50% of the time. Then
you can claim a whole lot, actually.
Aye. If you can use
a separate line that's specifically for my property business.
Exactly. That's the key here. To have a separate SIM card and a separate line apart from what you're doing. That way you're not getting disturbed except for on that line, and you know it's to do a rental inquiry or it's a problem with that. It's not your personal. So it's kind of keeping it separate and keeping that that separation in between your investments and your personal life.
Professional fees is another one, Jim. So if you're a member of the National Landlord, whatever.
I was just going to say it's the only one that's on the list that he's never mentioned. I was going to wait.
I would argue broadband costs as well.
Yeah.
So if you've got broadband costs if you're using them.
That actually works into your £6 a week working from home allowance.
Yeah. And what else? What else could there be? I think that covers the main thing. You've got the gas and electricity and water as well, or water's including council tax in Scotland.
Yeah.
So that's probably about it. If anybody else could think of anything.
Yeah, if there's anything else that we've not mentioned, I'd be interested to hear people's views on what they have maybe in their own experiences had as tax deductible expenses and things that we've not covered there. But I think that's generally the bulk of them. And I think
really, if anybody's not sure about that, then they could feel free to contact us anywhere, message us here personally.
Stationery, printing costs and stamps and stuff and toners for printers, you can claim all that stuff as well.
Yeah. Good. Okay.
Good.
But you, Richard.
Yeah, I think it's about making the most of your buy-to-let, and obviously if you're looking at all these aspects and doing right through that whole list, obviously that is going to obviously help you make the best of your buy-to-let. But I think also, like you said, Jim, talking about repairs and obviously the single glazed to the double glazed, it's all about making tax efficient repairs as well. And thinking about that as you do upgrades and things to the property without obviously being an improvement or doing repairs that could. Yeah, there is a loophole, like you say, there is a few loopholes where you could make improvements or upgrade things, but still have them tax deductible, like the single glaze to the double glaze.
Didn't use the word loopholes, please.
Okay.
Folk think they're dodging tax. It's like we're not dodging tax at all. It's perfectly legal. It's an allowable expense.
All you're actually doing is you're not engaging in tax evasion or avoidance. Really, you're just getting your ducks lined up so that you're using the most efficient tax regime.
Tax efficient repairs, right? That's basically
absolutely.
Yeah, and not only could you claim back the costs, but you'll also protect the value of your investment. Your tenants will obviously love you for the fact that you're looking after their home, which means they'll stay longer, and then you have longer tenancies, fewer complaints, and minimal void periods, which ultimately is the goal if you're going to be looking to do long-term buy-to-let investment. That's ultimately the goal.
When you talk about void periods and stuff like that, this is a good one. And now I stood up at a recent meeting yesterday. It was, I think, the housing minister was there, Patrick Harvey, and somebody stood up and tried to castigate me and said, You tell Patrick Harvey how much you're making in terms of that. Because I said to them, I'm making a minimum of 15% net return on what I'm doing. And he felt I would be affronted about it. But I went, no, I'm making 15% net return on what I'm doing. But I'm not charging anybody any more in terms of the rent. I actually charge, if not less than what the actual local housing allowance rent is set by the rent assessor, which is actually quite a low rate. But what I do is I keep my occupancy rate high and I keep my interest rates low and my cost of capital, and also I get good costs for my improvements and repairs. And that's how I managed to make a 15% net return minimum on what I do. That's the key. It's not about, you have to charge a decent rent, fair enough, but there's other ways to be efficient and actually make more money on the bottom line.
Yeah, definitely.
That was me just having a rant after yesterday.
No, that's fine. And the next bit I was going to go on to was obviously looking at things that are perfectly acceptable via HMRC, and obviously are a kind of win-win situation, like the window situation, where you're improving energy efficiency, you're improving the quality of the window in the property, but it's still considered obviously tax deductible. So be tax efficient.
Another top tip here, Richard. Sorry to interrupt again. It's all coming back, you see, because I'm thinking about what I do. So I get almost to the year end, which is the 31st of March for us. It's the 31st of December for my limited company. So I have two different setups. I have a sole trader and I have a limited company. And before I get to the year end, I just kind of look out where the tax is going to be in terms of that. And I think to myself, is there improvements I want to do before the year end just to be more tax efficient than actually do after the year end into the new year? And I get a better deduction straight away rather than having to wait. So it's kind of like that. I'll work on that. So again, if that's somebody wants advice on, then please feel free to contact us. And James, you're smiling. You obviously do the same.
So I do the same, but because I do my paperwork quite frequently and have spreadsheets and whatever else with various forecasts and projections and stuff like that, I know that towards the tail end of the year, if I'm coming in kind of high, I'll find something to spend the money on.
Aye, and when we talk about find something to spend the money on, so nobody thinks that we're running out and buying Ferraris. That's not what we're spending it on. We're finding something that we're spending the money on, and as if to say, I tell you what, I'm going to pull forward that new kitchen. I'm going to pull forward that new bathroom. I'm going to pull forward that new heating system because we're maybe coming into winter now. So I'd rather do it now for the tenants' welfare. And put the new kitchen for the tenants' welfare, put the new bathroom in for the tenants' welfare, or I tell you what, I'm maybe going to think about doing that roof again or getting it inspected. Yeah. So these are all things that we want to do and pull forward as a result, and that's exactly what James means by that statement.
Yeah. Also, I noticed obviously you mentioned about limited companies there, Jim, and I think if you are someone who owns more than one buy-to-let property, or obviously plan to do that and you're building a portfolio, then it's really important to think about maybe a limited company, especially even if you're a higher rate taxpayer as well. Obviously, looking at putting your properties into a company might be the right answer, as it will give you certain tax advantages as well. And I believe, obviously, I know both of you do that already.
Why do you do that, James?
Why did I do that? Well, obviously the changes in legislation as far as what you're able to reclaim, and I'm obviously building a portfolio for the future. I want to build generational wealth, and I've not done it perhaps in the best manner. I've started my company on a dumb basis, and it's all controlled by ordinary shares, whereas I should have had different classifications of shares so that I can hand it down to my daughter. But that's something I can retrospectively look at now that I know about these smart companies. And it helps things like succession plans, that sort of thing, for when I pop off the earth.
I know.
It basically limits IHT liability towards the end of your life and whatever else.
We think we're invincible, but the reality is you have to come to the conclusion if you are going to start and with this thing about building generational wealth, you have to think about how will that impact based on the current legislation if anything does happen to you. And will inheritance tax be a problem or not? And you're absolutely right. The company setup is probably the way to go for people, because the majority of occasions, most people will now probably start to, with a couple of buy-to-let properties, will probably start to fall into the higher rate category as a result. And it's through And it's amazing how they don't understand how that happens. But again, it's maybe a bit too lengthy and discussive for this conversation. But if anybody wants to know if they should be doing in their own name, they should be buying in their own name, or they should be buying a limited company, please feel free to contact us or comment on here, and we'll give you feedback on that, or we'll contact you and we'll do something about it.
And I did make mention of the pension system before, but even with a limited company, if you're still working, there is actually a way you can wash out your entire national insurance and income tax liability. So I've looked into it in quite extensive detail. And you can also do the same with a limited company. Obviously, if you're paying a pension from the company itself, then your corporation tax becomes lower.
Yeah, good shout. I mean, there's a lot of good information there.
Yeah, there is a lot of good information there, and like you say, Jim, anybody looking for any further information on that, feel free, obviously, contact us. But yeah, I mean, your rent received isn't added to your personal income if you've got a limited company, and instead it attracts corporate tax, which is currently around about 19%, with no upper tiers, unlike your income tax. And also, you could claim back interest on your mortgage as a business expense, as advantage that grows. And it's an advantage that grows your portfolio. So I think there's a lot of key elements there which are important about having a limited company if you're looking to grow and build your buy-to-let portfolio.
Now, I've been asked the question time and time again, and I've seen a question come in recently about this, about, you know, why is interest deductible against the full income on a corporation, on a limited company, but why is it not on a person? And the reason for that is because they can't do it on a limited company, because it will have further implications for every limited company and PLC. And that's why they can't apply that same rule, because they all have lending as well for corporate assets that they have. And it could possibly have wide ramifications throughout the business world. So I think for now that if you are concerned about the deduction at lower rate and higher rate for you as a person buying in your own name, again, limited company is the way to go. However, with that in mind, I suspect, and I have seen it in the past, somewhere on a discussion paper many years ago, where the government at some point in time is going to consider if you're the only one person employed by your company, or you're not employed, or there's nobody employed by your company, it will be taken as income rather than corporation tax in the future. How they're going to get away with that and how they're going to do that, I do not know. But everybody thought they wouldn't do it with the sole traders. And the Court of Appeal upheld it and said, yeah, that's perfectly legal.
I have a sneaky suspicion that they're going to try and use the same sort of thing as they've done with contractors and use the IR35 route.
Yeah.
You're an employee, you're then deemed an employee of the business, and therefore you end up creating this new employment structure and no rights employment.
Yeah. So that they'll get around it some way, and I think that will come in eventually. But so just be aware of that. So the key here is then what to do is, if your best mate's a landlord as well, then just employ each other on each other's payrolls.
How will that work?
You've got two people employed.
What about husband and wife teams, Jim?
Yeah, you've got husband and wife, and so there'll be ways to mitigate it in the future, possibly. But I've got a funny feeling it's going to happen eventually. Listen, though, the key here is don't let that stop you investing in buy-to-let. For goodness sake, there's an amazing amount of people who wait to see what happens. It's like, as I said before in previous shows, it's like I've got somebody that's still waiting after 30 years.
Yeah, I think now is the time. Man.
Well, now was the time 30 years ago, and every other day after that.
Yeah, that's what I mean.
You'll be a winner if you take the action. That's the thing.
Yeah, it's literally it. I mean, you know, setting up a company is easy enough. It can be actually done in 15 minutes online. It's pretty straightforward. You can buy them for about 50 quid, between 50 and 150 quid, depending on what type of additional add-ons you want to it. Mortgage lending is different, with fewer lenders and slightly higher interest rates for limited companies. Classic example, just now, I'm at the Bank of Scotland now, so they're going to give me base plus 0.279 interest only on my for my limited company, which I'm actually quite surprised about, because like the limited company mortgages now are something like 3.68. So I'm actually quite enthused about that. but there is other buy-to-let lenders that could give good rates. I mean, James, have you seen any good rates out there?
Yeah, I was just speaking to Richard before the show began. My mortgage offer came through for one of the properties I'm buying in Glenorchy at the minute, and that's came through at 2.76, and that's in the limited company.
Superb.
Yeah, that's good.
And is that fixed rate for 5 years or 2 years or 1 year?
Fixed rate for 2 years, so I've got the flexibility, obviously, then pull money out of the property once it's had a refresh.
Yeah, because I reckon prices will go up probably in the next 2 years, probably maybe about 10% in the next 2 years. In the next 4 years, probably about 20% in terms of the appreciation. So I think I might end up going for a 5-year fixed rate deal. That's where I think I will be. Because if it goes up dramatically, then I think for me the repayment clause, if there is one, it'll be probably minimal into what I could impact on getting the extra out quicker.
Absolutely.
But you have to weigh that up. Opportunity cost, opportunity loss, opportunity gain. That's management accountant coming back to an industry. And that's kind of how I look at it in terms of the buy-to-let business.
Well, I can take the view that if you wait out the 2 years, you can pull out the money, but then each subsequent deal has to be the sort of for the longer term. Because you're not going to be able to pull that money out each and every time you come to renewal. Yeah,
that's it. And would any of us pull the money out for buying a new car or anything like that? Would any of us pull out money for putting into new assets that earn money? Yes.
Yeah, absolutely.
Imagine being paid to wait till the price goes up. That's the only industry in the asset class where you can get that. But then, and we could boast about that, but the reality is we also take the risk that the price could go down.
Absolutely.
So that's the risk you take for being in business. So anybody that goes out there and says, "Oh, that's unfair," it's not really, because we take the whole risk and the whole matter, and anything could go wrong. Look at the one I've got sitting empty. I've had it sitting empty for 4 years because the guy upstairs will only fix the roof, and it's coming into my property. Luckily enough, the insurer's covered it just now, and I'm okay with that. And that's the point of planning correctly. Make sure you minimise the risk involved in that process. But I never saw that happening. So imagine if you weren't insured properly, and God forbid, Richard, it was maybe the same case as mine. We had that other landlord who insisted that I'm covered for DSS.
Yeah, but he wasn't. Yeah.
Right. And and the boy walked in the door and says, "Oh, we can cover that, no bother." What type of tenant's in there? Oh, well, it's somebody that's on local housing allowance or housing benefit. And he went, "Oh, I don't think we're covered for that." I'm like, "Oh, dear boy." Yeah. And yeah, I do distinctly remember asking that landlord at the time, showing him our insurance policy, showing him our insurance says you will be covered for every type of tenure under your thing. So don't worry. And he goes, no, my National Farmers Union policy will cover me for every type of tenure. And I went, "Are you sure about that? Please check." And he insisted, and then that happened, and lo and behold, it was £25,000 later in damage.
Yeah, that come out of his pocket. Yeah, for not having the right insurance.
Can you force the roof repair via the Tenements Act?
Local authorities wash their hands.
Yeah.
You're a landlord. You don't live in the property.
Yeah, that's been a difficult one, Jim. And luckily, like you say, you've got
the Tenement Act. It was meant to work on behalf of everybody and all homeowners, including us. Local authorities no board their backside. They don't want it. They don't want to give the time of day because it's not somebody living in the property. Never mind the fact that the tenant was in the property and had to move out as a result of that when he had lived there for several years before. Local authorities no bother, wash their hands, even though they've got a duty under the law to do it. So what does that say?
Yeah, that's an unfortunate one. But luckily, you've got the right insurance, which is yeah. If you didn't have the right insurance, then that would have been a different situation than what it is.
Somebody once says to me recently, last week, says, "Jim, I've watched your videos. You're awfully opinionated." Like, really? I never knew.
Where did they get that?
That's their opinion.
Anyway, let's talk about capital gains tax plan. Capital gains could be a real downer for a business, and particularly if you're a higher rate taxpayer with a large chunk coming off your profit when you sell a buy-to-let. Now, ultimately, obviously, this is an issue. Obviously, when you sell your buy-to-let, a lot of people, like you say, are in it for the long game. But you can offset some of this with your annual tax-free allowance, and also if the property was your main house before or after you rented it, but there is a much better strategy. So let's explore that then, Jim. You've dealt with your capital gains. I think you sold a few years ago.
Yeah. Last year, actually, and we talk about never ever selling and actually just remortgage the property, bring the money back out. But for me, the gain was too good to be true.
Yeah.
And for me, it ticked the right box at the right time to enable my daughter to get a deposit for her house. So it kind of made sense. And the advantage of having husband and wife with capital gains is if it's in your name solely, you can transfer any proportion you want to your wife on the same day with no capital gains involved, and you can use her allowance as well. Or vice versa. If it's in your wife's name, she can transfer some to you. If it's in both your names, you both get your allowance anyway. So you get an allowance of 24,600 if you sold a property in the year, and it was there was a gain of 24,600. So I've actually utilised it, and here it comes. I've actually got some of my properties now which I'm actually selling to my limited company because I'm utilising the capital gains allowance, selling it to the limited company, therefore not having to pay the tax on it because I really want to transfer it to the company, but I'll nail it to the wall. So this has allowed me to do it. Unfortunately, you still have to pay the 4% ADS. Mm-hmm. So you're still getting nailed for, if you're selling a property. One example was it was 76,000 I bought it for. I sold it to my company. I've had it for maybe about 10, 12 years, maybe 15. I sold it to my company for the market value, which is 100,000 just now. I don't pay any capital gains on it, but I'm having to pay £4,000 in additional dwelling supplement. So it's fantastic and it's not. So it's the yin yang, the rough and the smooth, the good and the bad. You just got to suck it up. It's a long-term investment. I'm going to hold it forever, and it's going to be passed on to my children as well. So it's going to earn money and appreciate still in value. So it made absolute sense, but it was a really good way to utilise my capital gains allowances.
And that's what I'm looking at doing just now.
Just going to say, James, what about you?
Add my wife as a director to the limited company, and then we both enjoy I don't know if we enjoy it, but we both get the capital gains tax allowance, just as Jim described before. So I think I'm going to be hit for about £6,000 all in.
Mm-hmm.
So that's the capital gains that will be due and the additional dwelling supplement.
And then you've also got the benefit as well, James. If the property was also your main home before or after you rented it out, sometimes there's more advantages because I'm sure I'm sure there's still the tax advantages with it.
So I think there's a 5-year time limit. I think there's a 5-year time limit if it's been your personal residence and it's been converted into a buy-to-let. So I think there's a 5-year period that you can move it across.
Yeah, there used to be huge advantages for having a what was it called, principal private residence. Yes. That was one of the tax advantages. Where if it was, you would have huge advantages, and like what James has said. But the government started to cut back on them and take them away. They took away the wear and tear allowance of 10% on furnished properties, so they took that away completely. I mean, that was a really good allowance, and unfortunately, that's been taken away. So that's brought everything down as well. So it's difficult to reinvest money if you're not getting these kinds of allowances.
Absolutely.
But equally as well, they've also got one as well when you go to sell it. I think it's been cut back, but I remember when I had it and you lived in it previously, if you go to sell it, even in the last 4 years, you get the capital gains free and you up to £40,000 worth of allowances. Now, I think it's been cut back to like maybe 10 or 15 or something now.
I think my solicitor told me that as long as I either disposed of it or sold it or whatever, within the 5-year period, then I'd be able to claim the ADS that I paid for the new property.
Yeah.
And it was quite substantial because we went from a £100,000 house into one that was like 3 times the value. So it was quite a bit of money.
But this comes back to the strategy about, if you never sell your buy-to-let, you'll never pay capital gains on it. That's the reality.
Yeah, I think, and then ultimately the best strategy is to never sell your buy-to-let property, and then you never pay capital gains, like you say, Jim.
Yeah. That's where it comes back to saying that if your property goes up in value, the classic example, if it goes up, say your property bought for 50,000, it goes up to 100,000. Your mortgage is only maybe 30,000 at the time. If you get 75% loan to value now on 100,000, you're getting 75,000 out. You've got 30,000 already, so you get 45,000 out. So you're getting 45,000 out, and it's literally tax free because there's no gain on it. It's no taxable. And therefore, you're able to take that 45,000, you're able to reinvest it to put deposit on buying another property, so you can actually earn money on that, and you're still earning money on your existing one that you've got because you've no sold it. So it is a really good strategy never to sell.
And going back a bit, there was another thing that I'd forgotten, but I've now remembered in terms of limited company expenses and stuff. So it's quite conceivable that when you start off your limited company, you will lend your company money. So that has to come back out at some point as a tax-free amount, because obviously it's a debt. And that lowers your liabilities as well.
Now, what you don't do what I did in the beginning, here's what I did. I actually put it in share capital. Damn. Or I put it in as a share premium, which again you kind take out. So if you're gonna give money to your company, set up shares, nominal shares, and put a token amount in as a share value, but actually lend the rest to your company. Therefore, you can take it back out when you need it, and it's not taxable because you lent it to them in the first place.
Yeah, I put it through as a director's loan, a loan agreement.
I've just done that recently as well, James. Yeah. Probably the other advantage as well. Lifetime, never to sell, still make money in it. I think the key here is, when I've talked about that, and let me qualify this again, I'm being very, very careful, because it will come across with some people like we are coining it in and we are raking it in at the expense of other people's, lifestyle. I'm talking about the tenants and first-time buyers. But you've got to understand, more or less every single person that lives with me chooses not to buy a house because they can't buy a house. Not because they want to buy a house, because they can't buy a house. Therefore, if I wasn't to have these houses, they would have nowhere else to be housed, because the government doesn't have any houses for them. So the key here is, by me saying, oh yeah, I'm buying another property and I'm making more money and all the rest of it, it's like, if it wasn't for me, they wouldn't have a house. If it wasn't for James, they wouldn't have a house, because he adopts the same way. We're not going out to take away houses from first-time buyers, to take away houses from people that want to upgrade or downgrade. We're actually providing a facility for what the local authority and the government is failing in.
Absolutely. And that's my methodology. It's not me buying another asset, it's me providing another home for a family.
Exactly. And my argument to this every single time to the government is, if you don't like it, build more affordable accommodation. 110,000 properties in Scotland over the next 10 years is not enough. Here's my opinionated bit. We are also behind already. The last 10 years, we've only done less than 20,000 when we need 25. So if you've got a shortfall of at least 5,000 at minimum, that's 50,000 shortfall. If you're building 110 now, you're only really building 60,000. But if you're falling back by 5,000 every single year and you're building 60,000 over the 10 years, you've only built 6,000 a year. You're only actually building what you're meant to build in the first place. If you're on the 20,000 out of 6, you're only building the 25 and above.
I'm sure I've seen a report that over the next 10 years, they're looking for 26,500 properties need to be built to even meet the need.
And that's the point. We're spinning wheels. We've gone right back, because they've never caught up in the first place. So all they're doing is replacing what they've not done in the first place over the last 10 years. So my reality is, do you think the buy-to-let market's going to continue to boom regardless of the 110,000 houses that they build? Absolutely. Yeah. It's not going to change. There's still going to be a huge demand. There's still going to be a huge demand on your properties. Rents are still going to continue to go up. And I don't actually see, after yesterday's discussion with the housing minister, that there's going to be a way that they're actually going to be able to control the rents.
Well, I was just going to say that obviously Patrick Harvey, he's been banging the drum about landlords and the evils and so on for such a long time, but he's never really considered what if that function wasn't there.
Yeah, I after the discussion, I think it's online somewhere anyway. But after that, what he said, I was actually thinking, you have no idea what you're talking about. You have not thought through the consequences of your actions. I mean, it's great to get up there for political points and actually say to the public, we think the rent should only be 25% or less of your income. It's like, that's all very well saying that. But if you cap that, okay, and you'll end up exactly what the utility companies are like now. Because as costs go up, then therefore our rents can't go up. Therefore, we can't reinvest. Therefore, guess what? We're repossessed. And if we're repossessed, the banking system collapses and everybody else comes with us.
Exactly.
And then there's no housing for anybody because all these people are now homeless because they've nowhere else to go, because they'll have to leave because the house has been repossessed.
And no one wants to get a mortgage.
Yeah, he doesn't understand, and they don't understand, and that's fine. They've promised a consultation, they've promised to go through the process, they've promised to tell us openly what they thought and take on account our feedback as well over this time, because I don't think they have the answer at all. It's good for political points and it sounds fantastic in theory, but in practice, I don't think it's practical. How on earth are you going to put a rental cap, think about this, on our rents in Scotland if universal credit is right throughout the UK? Because then you're out of kilter with universal credit. What if universal credit's more than what the rental cap is? That means universal credit and the government have to change. Well, they can't, because it's the UK government. That's the rule we live by now. So you'll not be able to go against that. People will actually suffer as a result of that because they won't be able to pay the rent because it's out of line with the actual UK system, which we're part of. So again, he doesn't understand, and I think he's touched on it a wee bit, because he did mention we're going to have a wee bit of challenge with universal credit. And you're damn right, yeah. you're not gonna be able to solve it, because you'll have to ask them to change for Scotland, and guess what? England's 10 times bigger. Do you actually think England's going to change for Scotland? No, that's not going to happen. So I don't think this will happen. I think eventually it'll get kicked into the grass, into the long grass, and that's where it'll stay. I think it's just a favour that the SNP's doing in order to get their votes on side just now.
Mm-hmm.
I'd be interested to hear anybody's comments on that.
No, a lot of good.
A lot of barrage of trolls on having a go at me now.
No, a lot of good points there, Jim. And yeah, if anybody's got any views, then please join in. Yeah, as you say, obviously rental demand doesn't show any sign of dwindling anytime soon. And I think if you are a landlord or an investor, you need to look at things for the long term, and properties that are going to give you a lifetime of service. And obviously, looking for the right properties and things, feel free to speak to myself or obviously anyone of the team for properties that are the ideal kind of property that's going to give you that long-term lifespan for a good, healthy buy-to-let portfolio. And as values increase over time, you're going to then obviously be able to use that capital to continually expand your portfolio, release some money, and you won't have any capital gains tax liability. So yes, it's all about thinking about it logically. And I think with the way that the market's going, like you say, with the dwindling social housing, the demand in the private sector is going to obviously just continue to increase. So yeah, that's probably a good strategy to kind of follow. And if you need any advice on that, definitely speak to me about property that will give you that long lifespan and a buy-to-let portfolio. So Jim, obviously you've just been building your portfolio. Mm-hmm. You've expanded it quite a lot over the last year. And this is the same kind of strategy you've adopted. In fact, it's the exact same strategy you've adopted. Yeah. And you obviously find it to be successful. And James, I know you use the same kind of business model.
It's a formula that works every single time. And I keep calling it the McDonald's formula of buy-to-let. It works once you understand the dynamics and how to do it. And it is fairly simple. Actually, I mean, the course I'm building just now, I was really desperate just to call it 3 simple steps to financial freedom, because effectively that's what it is. You find you finance, you fill, or you find fill finance, do whatever you want. But that's in its thing, and everything just flows down from there. All the wee subsections of what you need to do in order to achieve that. But a lot of people out there make this complicated so they can sell you a big, massive course at a huge cost. But the reality is, once you understand the fundamentals, you don't need these people anymore. You could actually literally do it yourself with the help of people around about you, like ourselves, that actually help you grow that business, because it's like-minded people. So I definitely think it's pretty straightforward to do, and anybody can do this. You just have to understand. You don't understand as well, probably, James. You maybe have experienced this in the beginning. It's like, well, where do I get the money from? And it's like you'd be amazed how much money you've got actually lying about, and you didn't really realise. I mean, at the start of the year, I said to you guys, it's like, oh, I'm going to set a goal of buying 8 properties, and it's like I think I'm on 17 now, and I'm after another portfolio of 16. And it's like, because then I started to think about, what have I got lying about? And it's like, and then it's like, whoa, wait a minute. God, I never kind of had that much. And it's like, let's have a look at the valuations of the properties now. And it's like, wow, like, really? It's and then when you start to think about all these things and the things that you can do, and then what was available out there in terms of the banks and stuff like that, I'd go to banks. I can't go to mainstream buy-to-let lenders because it's like too big. Computer says no. That's it. So I'm now up the level of just having to go to corporate banks now and saying, no, you fund me. This is what I'm wanting. This is what I've got, and they go, yeah, job done. So that's kind of where I am now. Whereas James, I think you're still at buy-to-let lenders.
So I'm still at buy-to-let lenders at the moment. Preferred lenders, obviously the mortgage works, but I think they've got some ridiculous like living house policy or living property policy or something before you then have to move on to someone else.
Yeah.
Have you thought about angel investment, Jim?
I don't need it.
Portfolio? You don't need
me
it?
For giving someone else. Do you mean me for investing in someone else? Because I certainly didn't need it. Everybody comes on to me and says, have you ever thought about bridging finance? I went, self-financing. And they went, oh, what do you mean? I said, well, if I want money, I'll just give it to myself. It's as simple as that. I mean, do you need insurance? Self-insured. Like, well, why is that? Because like, if anything goes wrong, I just pay for it. I don't need to really have the insurance. So my excess is £1,000 because it keeps the bills down. And it's like, I only really plan for the house burning down. That's effectively it. Disaster, recovery, if that makes sense. Apart from that, bits and pieces that happen here and there, I'm no bothered about the insurance. I'll just fix it. Keeps the bills low, especially when you've got a big portfolio. Yeah,
good strategies. And obviously, if you're building a portfolio, that's a good strategy to follow. Any advice on that, obviously feel free to speak to us. But if you do need to sell, remember that you can deduct the cost of improvements from your profits, like extensions, loft conversions, modernising, and you could also deduct the stamp duty that you pay, as well as the fees for estate agents, surveyors and solicitors and things as well.
Yeah, tell you a quick one. Somebody said to me the other day, it says ground source heat pumps actually fully deductible.
Really?
Allowances apparently in the first year. Even if it's classed as improvement, it's a fully deductible allowance. I'm not advocating putting a ground source heat pump, by the way, because it costs a fortune.
They do cost a lot of money.
I'm still not sure if it's people are just trying it out first. I always say wait till everybody else tries it out first and be the guinea pig, and once it's proved, then go and put it in.
Well, it's like air conditioning in reverse. So in these hot countries are often having to get repairmen out to fix air conditioning. So why would it be any different here? You're just doing the reverse process.
I know. I think it's going to be. It's not something I would pursue now.
In effect,
you'll be wrapping up, Richard.
Yeah. I was just going to say, just to kind of obviously on the tail end of capital gains there, it's also worth thinking about the timing if you do need to sell. Capital gains will be added to your personal income for the year. So if you're disposing of other assets like stocks and shares, or your income is likely to fall, it could be worth holding off until the next tax year just to reduce your bill. And that's kind of how we wrap up on capital gains. And we're actually running out of time, guys. So final thoughts on our topic today, Jim?
Get advice from the right people. That's really it.
I think that's really important.
Get advice from the right people. And it's not the people that have got the fancy cars and flashy houses. Look at their find out who their limited companies are first. Look them up on Companies House because it's free information on their public accounts. Then you'll find out exactly how much money they've got. Some of them haven't got a pot to piss in, by the way. And that's some of the ones you think are seriously wealthy. They called fake it till they make it. That's what they do. And they pretend to sell courses to you all the time, but that's how they're getting their money to pay for their next property. That's so they're getting off of you. That's how they're being rich. Anyway, that's me on my soapbox again. James, over to you.
Wrap up, Jim.
Always get the advice from professionals. I would say absolutely tax accountant or a good accountant or a tax planner or whatever.
Definitely.
And you can't go far wrong.
Brilliant. Look, guys, well, lots of good information. And anybody who wants any further tips or advice or to speak to any of us, please obviously drop a comment in the box or feel free to contact us at any time. But I'm going to wrap up there, so thanks for joining me, guys.
Guys, tomorrow, watch out for the Sunday slot, 10:30. I've got Paul Champolina, Slum Landlords, Tenants from Hell. He's on tomorrow, 10:30, Sunday slot, Paul Champolina. So we'll see you tomorrow.
Right, guys. Cheers for that.
Fabulous.
Bye-bye.